Program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. If you have any questions whatsoever on the bond or equity market, please feel free to pick up the phone, 1300 30 34 35, the email yourmoney@skynews.com.au. And joining me tonight on the panel is Roger Montgomery from the Montgomery Fund and Jonathan Barrett from Barrett's Bulletin. Welcome, gentlemen. How are you?
I'm well.
Yeah, good.
Good?
Yeah.
Let's start with you, Jonathan. Talk to me about Barrett's Bulletin. It's got a great alliteration. So how's it all going? What's the sort of, if we're looking at the bulletin, what will we get? If we
Commodities.
Commodities?
You know, when you said equities and bonds, the other asset class, commodities.
Oh, sorry, I'll rephrase that show. It's become such a mouthful for me. Okay, and so what are we looking at? Many people, is it 100 people read it? Is it a paid subscription?
It's mainly a subscription for quite a lot of media read it.
Yep.
Right, and also quite a lot of investors. The idea behind it is purely a macro theme, specialising in commodities. We look at precious metals, primary inputs such as oil, iron ore, coal, copper. So it's really those commodities that would affect how a lot of stocks would trade.
Okay, so you'll be right in the thick of it at the moment because of all the events that are taking place. So we'll be talking about that in a second.
Absolutely.
Roger, how are things for you?
Oh, phenomenal. We've been very fortunate. You know, we recently, since we last saw you, we celebrated the first year anniversary of the second fund that we launched. You might remember we had the Montgomery Private Fund, which has been now going it's coming up to 3 years.
I remember because you said you were going to cash and I tried to get you to buy TDs from Sonica, but you haven't done that yet, so we'll have to talk about that.
We'll keep talking about that. Yeah, you'll get us over the line at some point, I'm sure.
3% CDs, but we'll work on that.
But we launched in August. Last year we launched a second fund, which is called the Montgomery Fund. Yep. That's our retail offering, and it has finished the year to June 30 with about a 35. Sorry, the year to the end of this month with about a 35% return. So it's significantly
35% per annum this year.
Correct.
Right?
Yeah, for the first year. So we've been absolutely delighted with its performance. The business is going phenomenally well. We're featured this week in the Australian newspaper.
Jay, do you have any chance of bringing up that Australian newspaper at all for Roger? I just want to talk to you about that, Roger. I thought that was...
Did everyone like the socks?
Well, we'll just talk about...
I wear some very, very strange
clearly,
socks.
You've got some flash socks on here, mate.
They're called happy socks.
I'm a sock aficionado. I think it is right. It makes you feel good.
You feel good putting on a colourful pair of socks. You do. I've got a lot of friends who do the same thing.
My mother says, get into that suit, get out of that suit, but she never complains about the socks. So it works quite well.
You do feel good putting them on, don't you? You think, I'm ready to go.
You feel like you're business orientated.
And actually, a lot of dads complain on Father's Day. We're coming up to Father's Day, as you know, they complain that they get socks and undies or socks and boxer shorts or whatever it is for Father's Day.
Never complain because
if I get happy socks, I'm delighted, absolutely delighted.
Right.
So in a volatile week like this, and we'll talk about the, I want to make the point at the start. I mean, I got some emails from people saying, how do I take advantage of the Syrian crisis? And I want to make the point that that's not the email to write to me in particular, but that's not the email to write.
How do I take advantage of other people's misery?
It's absolutely terrible. And I don't want to offer a side, but I want to make an aside that you really are, you shouldn't be doing this. No one should be doing this. This is not the sort of environment to be seeing those poor children and anyone. It's just a complete disaster.
I've got some interesting, I don't know if we've got time now or after the next break, but I've got some interesting historical perspectives on that.
Okay, great. So I want to talk to you first, Jonathan, about your thoughts on the Syrian, the volatility and everything at foot. So, what's your concept of it in terms of market reaction and how people position themselves to sort of be more concerned about the Syrians as opposed to trying to work out their portfolio? Like, what do you think you do?
Yeah, well, I think, Mark, when you look at Syria, when you look at the Persian Gulf, you got to look at oil and you got to look at gold, and it's those two key commodities that will have an effect if something happens there. In past, we've seen whenever we get a geopolitical issue within the Gulf, we see oil spike up quite dramatically. but more often than not, it just comes down. So,
because you think it's spiking up because the traders looking to trade?
Basically, that's it. Yeah, the supplies we know about. There's no real disruption in supply there, so it's just the chance that Syria could flow or the contagion could develop in the region. But we know that just won't happen because the region needs US dollars. They need to sell oil. They need to sell oil. They don't sell oil, they've got problems.
Yeah.
So I think if anything, it's a flash. It'll happen. Prices for oil will shoot higher, but eventually they'll come straight back down.
What's your interpretation of the whole Syrian?
I think as investors we should expect that the destabilisation of the Middle East is here to stay.
Yep.
And there's some really good research you can read up there. Unfortunately, he passed away last year, but there's a Dr. Rufus Fears, F-E-A-R-S, wrote some interesting papers and gave a historical perspective on the Middle East. And his take on it's fascinating because what he basically said is that the Middle East doesn't want democracy. We try and impose it on them, but they actually don't want it. What they want is a strong ruler who brings in the rule of law and provides them with food. But because you've got so many different sects and different religious beliefs, you've just got a melting pot of conflict. And in fact, he said there was a lecture that he gave, and I know you're not supposed to ever read on television, but I'm going to do it on this one occasion because it's going to give every single one of your viewers some perspective on Syria.
And those on the podcast, listen clearly.
Listen clearly. The title of the lecture was The Lessons of Ancient Rome for America Today. It was given in September 2003. He said this: American troops are on patrol today in Baghdad. American men and women tread in the footsteps of so many armies who have come before. The charioteers of Ramses II, Pharaoh of Egypt, the Persian troops of Cyrus the Great, the Macedonian phalanx of Alexander the Great, the Roman legionnaires of Julius Caesar, the Crusaders of Richard the Lionheart, the troops of Napoleon, the camel corps of Lawrence of Arabia. All these armies have come, many of them with good intentions, determined to impose Greek or Roman or Christian or democratic values on the Middle East. All have failed, all have gone away, leaving barely a trace in the sand. The Middle East endures. Isn't that fascinating?
Absolutely.
Isn't that absolutely fascinating? And so we think, the Americans are going to solve the problem. They're going to bring democracy in. No one ever has. The Babylonians fought over it. The Hittites fought over it, over Syria. And here it is, still in conflict.
And this is Bonds versus Equities in Syria show, and I think
and a biblical analysis.
That's right.
Of Syria.
And I get all that, and I do. The geopolitical issue around the American role, if you like.
Yeah, but that's purely because of the oil and the energy they need. But
it's a good point, actually.
But that's all changing. Most funds, or most large funds, are in the US. They traded on these geopolitical issues.
Yeah.
But the consumption of oil from the Middle East to the number one economy continues to fall.
It's falling.
The new technology that we're seeing in extracting oil
the fracking world.
The fracking world.
That was where I was trying to. Nice segue, because I was going there.
We're on the same page because what's actually happening is the net exports from the Middle East is declining.
Correct.
And the reason it's declining is because they're using so much of it to generate electricity. They're using so much oil to generate electricity. Now, what's going to happen is their time horizon is so short. Now, they're just trying to stay in power. Their time horizon is shortened, and because the time horizon is shortened, they're not thinking long term, so they're not investing in alternative technologies, and that's going to mean more destabilisation over there. We're going to have more wars and more conflict as they run out of money to pay for food.
I think that's okay.
Yeah,
because that will be more to the Middle East. If you think really less than 1/3 of the oil that the US imports comes from the Persian Gulf.
Yeah.
So it's becoming less of a focus.
And I'll offer the point that there are conflicts happening in Africa that we would not be cognizant of because there's not oil. There's not the need. And the great travesties of those famines and the like, and because they're not relative to the Western consumption.
This is why we've got
to your point,
the UK and America and France and Europe trying to get involved because they've got financial concerns.
But if you're using less of it, then ultimately you think in the long-term horizon they become less relevant and they'll work out their situation.
And it's interesting because Rufus Fears, Dr. Rufus Fears says that we should actually not go in there. We should just let them sort it out like they always have.
And I don't know how we're going to bring this back into the markets, but we'll just carry on.
Well, what it means is
the question then becomes what happens with Israel.
What it means is you're going to get short-term spikes in gold. You're going to get short-term spikes in oil. It's going to happen. The biggest story, I think, from a commodity perspective is whether or not the alternatives get to such a critical point, critical mass, that we can actually begin to rely on them, and they're a stable source of energy for us, such that, and it happens in a sufficient time that we don't have to rely on oil from the Middle East, because we are running out.
Yeah,
well,
absolutely.
But that's been extended. I mean, the US will
the
be a net exporter themselves, where the world is effectively.
Well, that's precisely the point, isn't it?
Yeah,
that's the point. You know, can we get to that? Can we get to the point where it's not critical for us because our alternatives come up to speed?
So suppose if I was to ask you, in that volatile environment, what's your first priority? What's the first thing you're looking for from a portfolio perspective? What would you say? Just
safety.
Just ignore it, or do you go safe haven?
Ignore it or safety, I think.
We're value. You know, we I won't go so far as to suggest that we're taking advantage of the crisis, but what happens is you get big sell-offs in stocks because people think, oh, there's going to be a nuclear strike or whatever it is, or a chemical strike, and so they sell stocks. But you know, is what is happening in Syria going to affect the number of $2 buckets that the reject shop sells? No. Is it going to affect the number of customers that Woolworths has? No. It's not going to impact that. So we're looking for the market to react emotionally to things that really have no impact on Australian businesses.
Yeah. I tend to agree with that, but it's the weight of money that forces the hand of people to go into the market, and that's one of the issues. If you're a holder of Woodside or something, and all of a sudden the price moves higher, you tend to take a reaction to that, whether you sell it, whether you buy more, and that's just a natural thing as the markets look to try and get a little bit more greed out of it. But I think these events just force people's hands, and often they're the wrong things.
I like Ben Graham's quote. You know, don't listen to the market. It's not its wisdom that you're trying to take advantage of, but its wallet.
Yes, Ben Graham is very smart. Now, I just want to draw everyone's attention. We're about to go to a break, but before we do, I just want to give you a visual. For those in the podcast, I'm sorry about this, but this is Roger this week in the Australian. He's hit the big time. Now that's Roger with Mr. Buckland.
David Buckland.
David Buckland, who's the CEO of the organisation. And he's also the furniture removalist, because he's put that chair in there somehow. I don't know how you got that in there.
We gave the chair a tour of the office,
but
grounds,
David is
basically
clearly exhausted, and he's collapsed behind you, and you're sitting there like King Tut.
And we only own, other than this white one, we only own in the business those two shirts, and we just swap them between each other. Nobody knows.
Okay, so that's Roger for those who like with his colleague. We'll have to leave it there go for a very quick break, but please feel free to call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me tonight is Roger Montgomery from the Montgomery Fund and Jonathan Barrett from Barrett's Bulletin. They're here to answer any of your questions. Feel free to give us a call on 1300 30 34 35 and the email yourmoney@skynews.com.au. Roger, if we can go to you about the reporting season. I hear a lot about it, and I look at the various drafts that come through on Bloomberg. What was your sense of it?
Oh, look, I think for the companies that we've been following, which are the higher quality companies, those with bright prospects, there seems to be some success overseas, which nobody's really talking about that as a theme, but you've got companies that are doing very, very well overseas. For example, Flight Centre is expanding at an extraordinary rate in the United States. So that's going really well. And what was interesting is when we bought Flight Centre shares for the Montgomery Fund quite some time ago, people were saying, oh, well, if the Aussie dollar goes down, we're going to see a lot less outbound travel from Australia. And what's actually happened, that hasn't transpired at all, as the Aussies dropped from $1.10, $1.05, now 89 cents. Flight Centre hasn't experienced that. In fact, what's happened, and something that we anticipated, was that the airfare wars would bring flight prices down, and so it was less of an issue. The currency is less of an issue. More of an issue is how much does it cost me to actually fly overseas. And so that not only have they seen no detrimental impact from the decline in the Australian dollar, but their business overseas is growing. Breville Group growing fantastically overseas.
Let's talk about Flight Centre. How is it growing business in the United States when
it's rolling out stores,
Expedia, all that sort of stuff? Everything. So America is such an online world.
Yeah,
now.
but
and all those, you know.
But you go try
all that sort of thing.
But can I just say, I mean, we what we tend to do is we tend to throw everything. Humans tend to simplify things, or we like to. We throw everything in one basket online. Everything's going online. But what you don't understand is, yes, it's easy to book a flight online. Yes, it's easy to book a hotel online. But try and package up a tour. Try and organise your own tour of Europe online. You'll be there for a month trying to do that, online. It'll be a waste of your time. You're better off watching Big Brother or something, something mindless.
Hang on. Let's not go that far. We've got to take a phone call.
Okay.
We've got Chandra from Newcastle calling through. Hello, Chandra. How can we help you?
How are you, Mark?
I'm good.
Good. Great show, Mark. This is the only show that the general public gets some information on bonds, especially corporate bonds. Right. My question is on indexed annuity bonds.
Yep.
I'm just wondering, I'm a very conservative investor.
Yep.
From a super fund point of view, if I got 100 grand, the term deposits, you get nothing. Shares are quite volatile. So index annuity bonds the way to go from a longer perspective?
Yep. I think index annuity bonds are a great opportunity for investors, and I can draw your attention to, we dealt some ANU, Australian National University Index Annuity Bonds, and they traded at 4%, roughly between 4 and 3.8, around those sorts of numbers, and that seems quite low. But then you add inflation on top of that. So let's say it's 4 and inflation's 2.5, you'll get 6.5 for a AAA rated asset. I think some of these index annuity bonds are mispriced from the positive side, from the investor side, because
overpriced. You're saying they're overpriced? Oh, they're underpriced.
They're mispriced in terms of the return you're getting is terrific.
Oh, okay.
And by that I mean,
how does that? Not a low interest rate, a low inflation, low interest rate environment. That's unusual.
Our inflation has stayed between 2 to 3 forever and a day, and it's because these index annuity bonds are small issues, and therefore it's very hard for anyone to like a fund manager, to price out and buy them. So you can get really nicely rated Praeco index annuity bonds. You can get a lot of South Bank, so schools, hospitals, TAFEs, have all got these different index annuity bonds that will give you somewhere between 3.5 and 4.5. Sydney Airport's got a capital index bond, but it's around about 4 and a bit. That give you, if you add inflation on, let's say it's 2. Yeah. They're great returns.
Well, what's the parcel?
They're 50. You can do between 50 and 100.
But nothing less than that. Or that's
it comes down to the documentation. I think one of the things that FIIG's start, and Chandra, hopefully we're still advising you in the right way, but one of the things FIIG's done of late is decide to bring, I think all businesses, you'd be the same, all businesses are trying to reduce the cost to make the product cheaper. And so what we've decided to do...
There's massive pressure on price.
Massive pressure. But for us, it's not so much on price, it's trying to get that diversity. So what we've done, if the documents allow it, you can do $10,000 bonds. Now, because of the cost pressures on us as a business, we have a huge research team, and we do all the custodial business for free. We've said to the clients, if you can buy a portfolio of $50,000, assuming the documents allow, then you can buy 10s and 20s and make your 50 parcel that way. That's proving to be pretty popular because a lot of people don't want to buy just one bond. So
buy a basket of it.
A basket of it. So you can buy index annuity bonds in the smaller denominations, subject to, and we can talk about this later, the issuer allowing it. And sometimes the issuer will say it needs to be 500. So the Rabo index annuity bond has to be $500,000, AAA rated.
Well, that's a wholesale.
That was just a little line. You shouldn't have done that. That would have made it easier. So hopefully, Chandra, that's giving you some advice. I think they're great value. I think they're a great opportunity for people to buy.
But even that Welder bonds, I think, is a good value as part of your portfolio. Where a lot of people don't look at it. But when you've got your equities, you've got some of your commodities, well, hopefully. But you've also got the bonds as well.
Absolutely. We have another call. We have Kerry from the Gold Coast. Hello, Kerry. How are you?
Hello, Mark. It's basically a two-pronged question. I'd like to ask Roger, when they sell out and go to cash, I mean, do you go to for duration term deposits or bonds? And two, look, I've heard on Hot Copper, read on Hot Copper today that apparently InvoCare are going to relocate some of their crematoriums to possibly to the Middle East to take advantage of their high death rates due to the lack of death rates apparently over a warm winter in Australia this winter. Thank you, guys.
Yeah, so I know about the InvoCare result. The company. We should say at the outset that that InvoCare is Australia's largest funeral service provider. And they didn't complain, but the mild winter in Australia, and it is the driest or warmest winter on record in Australia, has meant a lower death rate in Australia. So less influenza and so forth, and so the company...
Now, folks, I just want to enjoy this because this is really terrific TV. Let me tell you, this is the best. We're going all over the world with this one. Let's go, keep going.
You know, it's just such a... I mean, yeah, we joke about it, but imagine running one of those businesses. You know, and the hardest thing about being a funeral director is sitting around and saying, mate, you'll look after my funeral, won't you? And then that bloke dies, you know, and then you're looking after their funeral, and it's so personal because you actually know them. They've got a tough gig. Anyway, InvoCare, I know that's a fact. They complained, well, they pointed out that the death rate was lower this winter. I don't know about the hot copper discussion. It's not a place where I go to get my information, but it's easy to find out if that's true or not. You just ask the company. So that was the second question. What was the first question again? You still there? Do you remember what the first question was?
I'll have to think.
Going to cash.
So, what do you do with your fund?
So the answer to that is because we're equity investors and we're always expecting to get back into the market, what we do is something really simple. We tier our term deposits or our bills. We tier them 90 days, 90, 60 and 30 days. If we've got nothing to buy at the maturity of the 30-day term deposit, then we roll that back into 90 days. So we've still always got 30, 60 and 90.
Rolling.
And that's what we keep doing. We just have a tiered or a cascading
and you can
series.
That stuff and get the cash.
Correct. We can't do bonds because the duration's too long.
Okay.
We have to go to another short break. We'll talk to Roger about duration after that break, or while we're having that break. But feel free to call us on 1300 30 34 35 if you have any investing questions, or email yourmoney@skynews.com.au. Welcome back to the bond edition of Your Money, Your Call. We do have equities, and we'll try and keep on none of
we need to talk about commodities.
And commodities. Feel free to give us a call on 1300 30 34 35 or email yourmoney@skynews.com.au on basically anything tonight.
We can talk about the Hittites, the Egyptians,
the reporting
Ramses.
season. Let's try and move on to the reporters.
Pharaoh.
We got one in. We got InvoCare in, and I asked you to have an actuary because clearly I can understand it, the reporting season being short term, medium term, all those.
Yeah, they were just commenting on they were just giving an explanation for their result.
Yeah, I worked in the insurance business in the States for a while, and no matter what that movement was, the actuaries would just look at you benignly and say, you know, you don't understand statistics, you idiot, and you know, it'll all fall back into place over time.
Yes.
What other things did you like? So
Flight Centre was an example of a company going well overseas. Yep. Another one was Breville Group, for example, surprising everyone with the popularity of their appliances in the United States. The big one for us, though, and one of the big contributors to our returns, has been Ainsworth Gaming, which is run by Len Ainsworth, who was the founder of Aristocrat. He's left Aristocrat and he's now in a smaller outfit. What I loved about that particular result was their total US sales, the biggest gaming market in the world. Their sales were up enormously in the US, but total US sales 49 million. So think about the upside potential there. Yeah. They're doing it again. The entire South American continent had grown 77%.
Whoa.
Sales were up to $19 million.
Right.
So you think about the upside. And another one that absolutely knocked my socks off. You know, we talk about online how many hits are you getting, how many unique visitors are you getting to your website. But not everyone purchases when they go to a website. We've owned Woolworths for a while.
Now, let's not go down that path.
No. But look at Woolworths. Woolworths' result. I don't think anyone really understands, and they mentioned this number in the result this year, the number of people visiting a Woolworths outlet, be it at Dan Murphy's or whatever it is, one of their outlets, one of their stores, per week, the number of unique visitors. Now, a unique visitor to a store, people.
Let's call them humans.
But you don't browse at a Woolies, right? You go in there to get something. So every visitor is...
It depends whether you're male or
hopefully she doesn't browse at Woolworths, right? But the point is, when you go into Woolworths, you're going there to buy something, right? You don't go into Dan Murphy's, right? 28 million visits per week.
Per week?
Per week. Isn't that fantastic? I mean,
what does Coles do?
Yeah,
well, I haven't got Coles. No, I'd like to get their number.
But you sort of feel sorry for the small grocer down the road.
Yeah.
Oh, look,
and the other people
I've
who are losing the business because of that.
I've actually been talking to Paul Fletcher and Andrew Robb about the power of Woolies and Coles, and
Paul Fletcher being the ex-CEO of who's Paul Fletcher?
Hutchison, who's now now Liberal member for Bradfield.
Wasn't he? Who was the Fletcher that ran Coles?
No, that wasn't Paul Fletcher.
That was another Fletcher.
But anyway, Paul Fletcher and Andrew Robb, they're all aware of the issues for farmers in Australia, and it is a big issue. Manufacturing in Australia is just about dead. We're really relying on the iron ore price now and the coal price more than anything else. And because we don't have manufacturing, we've seen what's happened. We've seen Darrell Lea go. We've seen music stores go. We've seen car manufacturing go.
Sure.
All this stuff's happening.
Seen businesses go in the country.
There's an imbalance.
It's a huge imbalance.
We've got a massive imbalance, and it's not good. It's good being a shareholder of Woolworths, but it's not good for.
I mean, I'm not a massive fan
for the
of
country.
Andrew Robb, to be perfectly honest.
Sure.
I mean, because of some of the outrageous statements, and he sits with Bob.
All
Catter.
I'm saying is I've spoken to them and talked to them about this issue. That's all I've said.
Right.
I haven't said
So you haven't changed their mind. They just want to get home.
I haven't said we hold hands and we walk down to the movies
right.
together.
Okay. Because we can have Mr. Robb and we can have a very buoyant talk. A lot of US conversations, so that's interesting. Let's talk about your view on the tapering, because that'll affect in terms of the volatility of the markets. John, what do you reckon about the tapering?
Look, the markets have certainly factored in the September tapering.
Yeah.
We actually feel that they won't do it.
Yep.
They won't taper.
They won't taper in September.
That'll be a huge problem.
And that's
for volatility.
For volatility.
Yeah.
The reasons that we feel that they won't is that there's still quite significant issues in the States. Sequestra, the debt ceiling being debated.
Mate, how many debt ceilings?
Hang on, let him finish here, Roger. Let him go.
As it always happens.
We all want a problem.
Come, Roger. Hang on, let him speak.
But what you've got... Yeah, that's okay.
I'm hearing you. I'm on your side, but I think it's ridiculous.
What we're actually seeing is an economy that can slow down.
Sure.
And that to me is the big worry that the Fed has. Also, when you look at some more issues in Europe, when you look at more issues in the emerging markets, the number one economy will be affected by what will happen. So if that starts to slow down, then the Fed will make a decision, I think, not to taper, because they just want to keep the status quo. In fact, I actually feel they'll use tapering as a means to contract monetary policy if in fact inflation starts to pick up, if it does. So it's more of a contractory tool if the economy takes off, but it's not.
Well, last week I made the point that I think the taper happens in September, and I'll tell you in a minute why, but I think that September is volatile naturally. So tapering, people haven't seen that. At the moment they're buying 85 billion. They still buy 85 billion, and interest rates have gone from 2 to 4. So they're still buying the paper. Yeah. The reality is that they don't know how to taper. They won't, because they've never done it before, so that makes it volatile. In the event they don't taper, that's volatile. Yeah. So just as long as you know that September will be a crazy month, because October's not going to be the reason for tapering, because they're nervous about the equity market in October. But I actually think it's the politics. I think the politics is the key to all of this, because, and I'm the only one that's saying this, everyone's disagreeing with me, but I think Bernanke is the vocal person. He's the spokesperson for the economy. He's the guy that says it's all going well.
Absolutely, yeah.
In the event it's Summers, let's say for Joy it'll be Summers, because that'll be great theatre, but regardless of whoever it is, if it's Summers or Yellen, for them to be doing the tapering, for them to be the start of the tapering, is much more volatile to the economy.
It's passing the buck. Bernanke
completely,
and so that's why they haven't made that decision.
Summers is called by some hedge fund managers and fund managers lunatic Larry. He believes that quantitative easing has had no impact on asset prices.
Asset prices has had, but I don't think it's done any good.
One of the senators from Kansas said that I wouldn't let Summers mow my lawn. Let alone have it be a fair check. So I think it'll be an interesting argument to make him, if he's nominated, for him to go through that process will be quite challenging.
That's why we've got that indecision.
Two paths for tapering. There's the orderly withdrawal, and there's the disorderly withdrawal.
No such thing.
The issue, I think, the only thing people need to look at for a certain bet that it'll be a disorderly withdrawal is a speeding up of the US economy. If it goes faster, then that's actually going to be a huge problem. Because if it actually speeds up, then the ability to withdraw quickly disappears, and particularly if Yellen gets in, because Yellen has already said in a lot of speeches, she's already come out and said, look, we may not taper as quickly, we may not withdraw as quickly as people think if the unemployment rate stays persistently high. And that's a problem if the economy starts to speed up. So if they keep that the foot on the accelerator while the economy's speeding up, you could have a lot more volatility.
They'll use it as a tool to slow that volatility. I mean, we've got the inflation issues, I guess, in the emerging markets, but if tapering will either go on for a long time, or if it does start to pick up, or inflation starts to pick up, then they'll use it as a tool to contract the monetary policy. And that to me is something that...
Well, what they can also do, though, is they could also increase...
We'll go to another break, but in short, I just don't think there's such a thing as orderly, and I'll talk to you about it because I think it's the idea that...
They can't raise rates, that's not going to do anything. They can't sell the bonds. Imagine selling one... Sorry.
We have to go to another short break. Please feel free to give us a call. Roger's on fire. The number 1300 30 34 35. The email yourmoney@skynews.com.au. We'll continue while the ad's on. Be right back. Welcome back to the show. If you have any questions about the bond or equity market or commodities, please pick up the phone and call us on 1300 30 34 35. The email yourmoney@skynews.com.au, and we will take our first viewer email. It's from Vish, and he writes, I have recently set up an SMSF with the current asset allocation of 40% property, 40% cash and 20% equities. I'd like to reduce some of the cash holdings and invest towards bonds. With only about 20k to invest, how would you recommend I go about doing it? FIIG Securities, minimum balance of $50,000, and therefore I cannot go through them, ! I've looked into various government inflation-linked ETFs and listed ASX, GS1010 and GS1020. I can't seem to work out when is the right time to buy bonds and how to tell if I am paying a reasonable market value for a bond. I'm looking for a yield of at least 4 to 5% in the current market. I'd love to hear your thoughts about that and the other experts, and thank you for taking my question. I think it's a twofold question. One is we mentioned earlier FIIG's trying to reduce the costs, and so if we could, and feel free to email me or call me. My email is markt@FIIG2eyes.com.au, and I can talk to you personally, Vish. So it's hard to give advice around individual portfolios because you don't know enough of the circumstance. But I don't know that the ASX corporate government bond is going to give you the returns because we think sovereigns will rally. It'll be hard to get to the 4 to 5. So I think it's a question of maybe looking at some other
if you go
exchange traded.
If you go now, you get what you get.
Yeah.
As long as you hold it to the equivalent of maturity.
Yeah, that's right. And I think that to some extent the corporate bond market that is listed on the stock exchange has probably got some good... if I was talking to Bish and looked at this portfolio, I'd say maybe go to the hybrid market and look at some of those subordinated debt instruments and look at those for the banks. I think they're reasonable returns if you're trying to get into some credit that way.
I'll just take a step back and ask, how is it that he's got to the point where he's decided 20% is the appropriate amount? What's his process so that he can consistently make these tactical decisions? Because clearly that's a tactical decision, and what's the overlay in the process to make that decision?
And that's my point about, we are looking to reduce costs to $10,000 and reduce that all the time. And my point is, Vish, email me and we can try and talk about the machinations of what you're looking to achieve. But it's very hard to say, this is what you have to do. But essentially, there's some good hybrid opportunities that you might look at.
Corporate bonds?
Well, that's what he's talking about, trying to buy some of these corporate bonds. Some of the listed, like some of the banks.
Would you be extending duration now or shortening duration? What's your view?
Me personally, I'm an extender of duration. I think it's the 2018.
Not because it's good for your business.
No, because I really feel that the Fed's going to get it right. I think I think interest rates will be low till 2016 minimum. And so if I buy a 2018, 2020 bond, when they start to tighten, I'm actually shortening duration every day.
It's interesting.
So by the time they move it up, I've got a 2 or 3 year bond. That's what I want.
If you go back 100 years and
we have to take a call. We have John from Sydney calling in. Hello, John. How can we help you?
Hi, I'd like to ask a question to each member there. Firstly, for Roger, Roger, having three assumptions, assuming Aussie dollar's got 10% more drop left in it, the housing market's got another 10% rise, and the Liberals come in, what would be the two best stocks for each assumption there? And a question for John, does he think there's synchronized growth coming in Japan, US and Europe, and how will that affect commodities? And a question for Mark, emerging market bonds might have been sold off recently, and when does Mark think maybe good time to get in, and which emerging market would he look at more, and if there's any fund he could recommend?
Okay. Shall we start with you?
Okay, so...
They're great questions, by the way.
He's getting good value for his phone call.
That's right, and thank you for taking the time to put them together. We do appreciate people reading through, so that's great.
So in relation to equities, we make decisions about equities not based on strategic inputs. We make decisions based on what we can find in our universe of very high quality companies that are currently cheap. So you have to flip the idea on its head and think unconventionally, rather than saying, okay, well, I believe I should have this much in equities and the libs are going to get in, so which stocks am I going to buy? We're more opportunistic than that within our universe. So we say, okay, these are the high quality companies, these are the A1 businesses that we want to own at some stage if they are presented to us cheap. And that's how we go about it. It is very different. So we don't ask ourselves, well, what's the probability? Well, actually, I should correct that, because we did that once just recently. When Rudd came out.
Mr. Rudd.
Mr. Rudd, is it?
Thank you.
Oh, is it Mr. Rudd? Okay, sorry.
We're working on that.
I thought it was Ruddy. But when Mr. Rudd, when Prime Minister Kevin Rudd came out and said he's changing FBT, then what happened is McMillan Shakespeare went into a trading halt and then was suspended. Now, we worked out the probability of that legislation getting up to be about 16%. There was an 84% chance that it wouldn't get up. So in our view, there was a 16% chance that McMillan Shakespeare was worth $5 a share, and an 84% chance that it was worth about $13 or $14 a share. So on a weighted average basis, we reckoned it was worth about between $11 and $13 a share, and it opened when it relisted. It opened at $7.
Yeah, right.
So we thought bargain.
Let's do that.
Absolute bargain. And so we were one of the biggest buyers on the morning of the day it relisted at $7 and $7.25. That's the only time when we've ever, if you like, taken a bet on an election outcome. But we were fairly certain.
We're moving a little bit away from where John was questioned, but that's not a bad thing. In that, do you put much money to work on that McMillan Shakespeare when you say you buy a lot, but was it?
So in terms of portfolio construction, we're not making portfolio construction decisions or constituent decisions based on strategic notions, which is what the question was about. Right. What we're doing is we're saying, okay, our maximum position could be 7.5%. If we find something that meets the criteria, plus its liquidity is sufficient to have the maximum weighting, well, that's where we'll go to. But then we restrict that 7.5% based on liquidity. So if it's a smaller company, we can't have as much because it'll take too long to get out if we're wrong.
Yeah, John, just in terms of commodity demand, I guess with Japan, what's happening there? John, Abe economics is basically all about, I think, stimulus, as we know. I think when you look at the energy side of it, you're going to get a lot more significant demand for energy out of the Japanese economy. When I look around the emerging markets at the moment, there's a huge debate as to whether there's a crisis or whether there isn't a crisis. I'm certainly of the opinion that it's not a crisis, and at the end of the day, I think that the emerging markets economies are quite solid, right? I actually feel this is just a breather. How it relates back to Australia, I think at the end of the day, we're just going through a resting period for demand for commodities.
For my opportunity to answer your question, I feel there's some great opportunities in the corporate bond market in Australia, so I wouldn't be putting too much money to work in the emerging markets. Other than to say that the emerging markets trades a lot in the US dollar, and there'll be some experts who will know some of those opportunities you could buy that. To that end, if I was looking at a fund manager, the two that I like as fund managers are Aberdeen and Capstream. And Capstream have actually got foreign currency. It's a US dollar currency, but it's a foreign investment thesis. And so they've got a fund there that I think is still on some platforms, or has just been launched on some platforms.
But it's still not too bad to get into funds in US dollars if we think the Aussie's coming down, because that's giving you that hedge you need.
And also, but they're buying in credits that they understand offshore. So that's the opportunity. Rather than taking the currency risk in the Indian currency or the Indonesian currency, you might take some credit risk but with a good fund manager like a Capstream or an Aberdeen.
But even having said that, some of those currencies in the emerging markets have been exceptionally weak.
Yeah.
So they've got to turn around. The economies aren't as bad as what people think.
But that doesn't mean I'm going to say to the investor to go and have a crack at that, because I have no idea if that's going up. Look, we'll leave it there and go to another quick break. If you have any questions on bonds, commodities, equities, politics, please give us a call on 1300 30 34 35 and the email yourmoney@skynews.com.au. Welcome back to the Bonds and Equities edition of Your Money, Your Call. We're still taking calls. The phone lines are open. Number 1300 30 34 35. The email yourmoney@skynews.com.au. And we have another email. The email is from Kyle from DY, and he says, Cameron Klein says we have a debt problem. What did he mean? Cameron was talking about the fact that we don't have enough debt. And I think Cameron is talking about how we've downplayed the natural conversation around how we build infrastructure. And he's probably right. I think Joe Hockey...
There's a massive appetite for income securities from the generational avalanche that's looking for it.
Enormous.
But you've also at the same time you've also got you've got the Henry report coming out that came out and said we need more deferred annuities. Lifetime annuities, and that's a very small portion of people's portfolios on an aggregate basis in Australia. It needs to be much larger.
Yeah, and the problem is it's the dumbing down of the argument, and it's been both sides of politics. We're going to a surplus and we're not going to have any debt. And I can see it on the screen. We're going to reduce your debt. We don't have any debt. We don't have enough debt. That's crazy. So let's assume there's a change of government. How does the economy respond? How do you guys see the economy going at the moment, and how do you think it is 6 months from now?
Don't we go?
Yeah. I think the economy has to go through that transition stage. A lot of people are arguing at the moment between the mining economy and the service economy. I think that will be to our detriment to a certain extent, because we've lost a lot of spend on the mining side, and I think the way we're reading China and how that's expanding, that argument there, we actually feel we'll be a little bit left short of retaining those orders from those growth economies. So when I look at it, I tend to think that a Liberal government will basically be quite conservative for investments. The market will like it. I continue to see growth, particularly a lot of growth out of Australia.
I think we've got a recession in mining, right? So that sector of our economy is in a recession, there's no doubt about that. We've seen SEEK came out with their online job ads for Western Australia down 40%, right, the number of ads. We've seen negative growth out of Western Australia. We're seeing it out of Queensland and Northern Territory. That's in recession. Now, everyone's expecting a V-shaped recovery. We've had Boart Longyear say that's not going to happen. It's going to be an L. We don't know when it's going to be a U, it's an L. So it's a big issue. The bubbling issue for Australia out of China is pollution. Record-setting pollution this year in China, warnings in Hong Kong just this week, to stay indoors, and this is happening more and more. They are going to have to reduce their reliance on coal, and we're going to see, and that will have an impact, a long-term impact on Australia. But more importantly, I thought the last time I saw you, my view was, and I still have I think there's some probability of this, that the recession in mining and mining services expands to the broader economy. However, the caveat to that, and something that we're witnessing now, I think, is confidence that's pushing back as a result of rising house prices. So what we're actually seeing is we thought the West would actually export, Western Australia would export recessionary sentiment to the East Coast. Everyone would pull their heads in, stop spending, and that'd be a huge problem for our economy. What we're seeing is the East Coast is pushing back and saying, no, we're feeling pretty confident because house prices are going up. So how that plays out will ultimately determine the economy. But let me say this, the economy in the United States has been cactus for a long, long time, and we've seen the stock market double. So stick to great quality businesses, buy them when they're cheap, don't worry about the economy so much. Think about what the impact is for particular businesses, but don't try and apply some macro overlay to your equity investing. There's no need to do that.
What about the idea that the low interest rate environment, we will be in a low interest rate environment for quite a while. The fact that it hasn't been as stimulatory as the RBA has wanted, has that been a bit of a shock? That's certainly a shock to them.
People are reducing debt.
They're not doing anything. It's just that they're reducing debt. The low interest rate environment hasn't stimulated. People aren't the economies aren't responding to
I just want to challenge you on this idea that that we're going to have low interest rates for a long time, because if China does slow down even more and they're less enamoured with the mining boom than they were in the past, then they're going to withdraw their investment in Australia. Now, the current account, the capital account surplus that we have from foreign inflows is supporting our current account deficit. We could have another recession that we have to have. We could see interest rates go up to attract that foreign flow to support our current account deficit at precisely the time the economy doesn't need it.
Yeah, I get that, but I think we've already got a high interest rate environment compared to the rest of the world. So I don't know that that's necessarily going to happen. I think that the Australian bond market pricing where it is compared to the rest of the world, and I just don't think that the rest of the world's got a great driver. We can talk about the US. People say to me, "Why do you talk about the US?" It's if they sneeze, we get a cold, and you look at
China,
but everyone,
but China's driven by that brick economy. It's driven by export. It's driven by the United States. The United States becomes where you keep coming back to it, and it's been remarkably strong when you consider the headwinds they create for themselves. Debt ceiling. I think that Q4 is incredibly volatile. I think it's the tapering, it's the Fed governor, but what about the sequester? That's just crazy.
That's something that has to come to the fore again.
Yeah, but it comes to the fore all the time. It's not like the first time.
This confidence thing. This is the big thing. The market.
They extend it every time. They lift it every single time.
I think it's the key to this is the extraction they've taken, and this is genuine. They extracted from the Democrats a very severe penalty, and it worked. The economy continued on, and the Republicans believe that crash and burn, just burn it all out, will be the best way for the economy. And we have to go to a break. And that'll be our last one. It's time for a very short break, and I'm finishing on my note. We'll be right back in a second. And welcome back to the show. It's our last segment for the night. We'll start with an email from Tom, and Tom writes, "Hi, do you think that all bonds should be traded on the ASX instead of over the counter? Do you think this would encourage more brokers to recommend bonds to clients? Thanks, Tom."
Well, first two questions there. First one, yes, you would get more transparency in pricing. Everyone would know what the price is, but it's trading on a market. Second part of the question, would brokers recommend them more if they're on the ASX? Of course, their systems are set up. Their systems are set up to trade on the ASX. So if there's bonds on the ASX, they can recommend them and they can get brokerage from doing that. So yes.
Yeah, I think it creates more openness towards the market if that's the case, because then people can readily see the transparency. And I think the bonds really don't play an important part of people's asset allocation. And I think that really needs to change, because it does create that steady flow of income.
It's accessibility, isn't it?
So can I take the opposite?
Sure, of course.
I guess the idea for me is it's all about the education, and the over-the-counter market is much bigger than the equity market. They trade in billions and billions of these bonds. So there's a vast array of those bonds that are taking place in the over-the-counter. So let's say there's a very large pool of water and it's warm and hop in. The question is accessing that so you access at the same level as the institutions. Now, what I feel is happening is in the hybrid world, because the equity guys are selling the bonds, they don't spend this. I'm not trying to be negative on them,
but it's easy for a retail investor to be ripped off in the over-the-counter market.
That's the transparency
issue. That's the issue.
Yeah.
But they're getting ripped off in the exchange rate, because that's what ASIC has just said.
But
ASIC has said the problem is that the people selling don't have the level of information, so they're just delivering paper. And so in today's
I'm only referring to the transparency in terms of pricing. I'm presuming that you understand the product.
And clearly they don't.
The problem is people don't understand the product.
That's the key to it.
So it's a different issue.
The function isn't necessarily. The question is, can I access it? And the ASX has got their agenda, they take fees. The stockbroker have their agenda, they take fees. The transfer mechanism, with the way people have got software nowadays, you can see prices on anything, anywhere. You can go and look at a house and say, okay, and see it online and see all the pricing. So the question is,
buy it online now.
The question is about the education. So I think it's more about people coming to a conclusion of whether bonds will be part of their portfolio.
Absolutely.
It's a more macro movement, as opposed to, okay, let's list on the stock exchange, because I can assure you, the lawyer that issues $1 billion on behalf of a corporation, he'll create a document that's in the interest of the issuer. He won't create a document that's in the interest of the investor.
So it's the same in an IPO.
Exactly.
But you also look at the level of bureaucracy that around the issuance of these products.
Yeah.
every product we've had, the ASIC have gone through and just made it totally transparent.
Yeah.
And that to me is an issue that has to be dealt with.
I suppose to some extent it might mean there'll be less bond bashing when stockbrokers can sell bonds, because they come out there.
Yeah, it won't be about bonds.
They bash
this
the
show
bonds.
won't exist. Bonds versus
exactly.
equities.
Bonds, it'll be nothing. It'll be the Mark Todd interviewing Roger every week. It'll be because the idea is that the
a merge of our companies will merge.
Yeah, that's right. Yeah. The idea that the bonds pose a threat to equities is fundamental to so many of these arguments. And you like to say that we should be able to ultimately move the conversation on to say everyone's portfolio should have a common, get a house at the end of the day, get some bonds at the end of the day, because of that age and risk.
Can I just say, that is, I hear that, provided your advisor is an expert in those asset classes.
Look, I think the future. I couldn't agree.
That's what
I couldn't agree more.
Yeah,
the future salesperson is, you ring up Mr. Smith and you'll either have the bond advice and you say, Mr. Smith, our bond guys are saying you should do this, and our equity guys are saying you should do this, and that's how it gets.
And our commodity guys are saying.
Correct. The advice to the client is driven by maybe more research, but also more people providing the salesperson is better skilled. Because at the moment, the equity guy, he just simply says, buy this. Yes. And on that note, I'm going to say goodbye, because we're right on the wrap. That's all we have time for today. I'd like to thank Roger Montgomery from the Montgomery Fund. I'd like to thank Jonathan Barrett. I've lost my screen. Jonathan Barrett from Barrett's Bulletin. I hope you all have a great Friday night. Enjoy it.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision